There is a dangerous illusion in the West. It is the belief that a number on a screen, a paper contract typed up in a Manhattan high-rise, can dictate the physical reality of the earth. But today, that illusion began to crack. Silver hit $80.32 per ounce in a single trading session. One day earlier, it was sitting below 77. 1 year ago, you could have picked up an ounce for less than $33. That is a 147% gain in 12 months. But while Western analysts scramble to figure out if the $80 ceiling will hold, the East has already moved on. In Shanghai, silver just closed the week above $90.75. The paper market in the West sits at $80, while the physical reality in the East prices it $10 higher. They are reading an entirely different tape. This is the trap of normalcy bias. We are conditioned to think the paper sets the price until the vault runs dry and physical scarcity violently breaks the spell. The paper traders are playing a game of musical chairs, and the music is about to stop. If you are someone who is tired of the financial headlines lying to you by omission, make sure to hit the subscribe button and give this video a thumbs up, because what we are unpacking today is the difference between paper wealth and physical survival. Let us talk about the math, because the math does not care about your feelings, and it certainly does not care about Wall Street price targets. We are currently sitting in year 6 of a structural supply deficit. According to the Silver Institute, the projected shortfall for the year 2026 alone stands at 46,300,000 ounces. That is not a rounding error. That is a massive, gaping hole in the global ledger. For 6 consecutive years, the world has consumed more silver than it has pulled out of the earth. But here is the psychological trap that catches 99% of investors. Human beings are terrible at evaluating slow-moving structural crises. We react to sudden crashes, to red numbers on a screen, to breaking news. But a deficit of a few dozen million ounces a year spread out globally? It feels invisible. It feels like a theoretical problem for tomorrow, until, of course, the warehouse is entirely empty. You might ask why the miners do not simply dig more out of the ground to meet this surging demand. This is where the physical reality of the earth completely dismantles modern economic theory. You cannot just turn on a silver faucet. Roughly 2/3 of all the silver mined on this planet is a byproduct. It is essentially an accidental discovery when massive mining companies are digging for copper, zinc, or lead. Nobody sinks $2 billion into a massive new open pit operation just to find silver. The production decisions are driven by the broader industrial base metals. So, even in a decade where the price of silver has more than doubled, global mine production has barely moved, hovering around 820 million to 835 million ounces a year. Let us look deeper into the reality of that mining constraint, because the mainstream financial press completely ignores it. If a company discovers a rich silver vein today, they cannot just put shovels in the ground tomorrow. The regulatory permitting, the environmental impact studies, the community negotiations, and the actual physical construction of a modern mine take anywhere from 10 to 15 years. We are trying to solve a 2026 supply crisis with infrastructure that should have been funded in 2010. The supply is fundamentally inelastic. It is trapped by geology, suffocated by bureaucracy, and constrained by economics. Even the Chinese vaults, which seem massive at 1,416 tons, are actually climbing back from a hole. 5 years ago, that number was over 7,000 tons. The restocking is real, but the floor they are restocking from is structurally below historical norms by a factor of 5. And while the supply is trapped, the demand is mutating into something the world has never seen before. Silver is no longer just a shiny disk you hide in a safe to protect against the devaluation of your currency. It is the literal nervous system of the modern technological age. It possesses the highest electrical conductivity of any element on the periodic table. You literally cannot replace it without losing critical performance. It is inside the switches of every electric vehicle. It is inside the transformers of the global grid. Most importantly, it is the invisible infrastructure powering the artificial intelligence revolution. The massive data centers required to train these new digital minds run incredibly hot, and they require staggering amounts of power and highly conductive material. During the Second World War, the United States government had to secretly borrow 14,000 tons of silver from the Treasury just to build the wiring for the Manhattan Project, because copper was heavily rationed and silver was the only metal capable of handling the electrical load. Today, the technology giants are fighting their own quiet, multi-trillion-dollar war for dominance, and they are relentlessly draining the physical silver market to build their digital arsenals. There is a counter-argument you will hear from mainstream analysts regarding industrial demand. They will tell you that the solar panel industry is learning to use less silver per panel, a process called thrifting, and they are correct. Solar manufacturers have aggressively engineered their cells to reduce silver content, and demand from that specific sector is expected to drop by roughly 7% this year to about 194 million ounces. But here is the piece of the puzzle the analysts conveniently leave out. Global solar installations are still growing by 15% annually. The world is building more solar infrastructure than at any point in human history. They are using slightly less silver per panel, but they are building millions more panels. The floor for industrial consumption remains absolutely enormous, and engineers are quietly admitting that this thrifting process is hitting its technical limits. You cannot reduce the silver to zero without breaking the physics of the panel. But what happens when you combine a trapped supply and an insatiable industrial machine with a sudden retail panic? You get a violent, uncontrollable squeeze. Physical investment demand is forecast to rise by 20% this year to 227 million ounces. Ordinary people in the West, who slept through the first half of this rally, are suddenly waking up in a cold sweat. India never stopped buying, the Middle East is loading up, and you have to remember a critical distinction here. When someone buys a paper contract on an exchange, no metal actually moves. But every time a physical coin or a 100-ounce bar is purchased by a retail investor, that real, tangible metal is removed from the market entirely. It leaves the vault, travels in an armored truck, and vanishes into a private safe. It is gone. Contrast this quiet, relentless exodus of physical metal with the absolute circus happening in the broader equity markets right now. In the span of just 39 days, $10 trillion of market capitalization was added to the stock market. The technology index ripped through 29,000 for the first time in human history. The broader market is up 27% from the bottom. We are witnessing United States equity exchange-traded fund inflows hitting $6.8 billion in a single week. Retail investors, fueled by fear of missing out, piled $1.1 billion into individual tech names in 5 consecutive weeks of buying. Let us look closely at the psychology of that melt-up, because we have seen this exact behavioral pattern before. Right before the dot-com crash in the year 2000, the broader market rallied roughly 12% to reclaim its previous highs. Everyone piled back in, absolutely convinced the internet was a one-way ticket to generational wealth. They were right about the internet changing the world, but their timing and valuations were entirely detached from reality. They still lost 50% of their wealth over the next 2.5 years as the financial bubble violently corrected. The volatility ratio today tells a very dark story. The index is moving 7 times more violently to the upside than the downside. Why? Because nobody owns enough upside exposure, and forced buying from leveraged funds is dragging the market higher. We saw $118 billion of forced buying in a single month. Forced buying in a melt-up is exactly what creates the violence on the way down when the flow finally reverses. While retail investors are mortgaging their futures to buy wildly overpriced semiconductor stocks, you need to watch what the smart money is doing. What are sovereign nations doing behind closed doors while the public is distracted by the stock market casino? They are quietly heading for the exits and exchanging their fiat paper for the earth. The People's Bank of China just added another 260,000 ounces of gold to their reserves in a single month. That marks their 18th consecutive month of buying. 18 straight months of aggressively converting paper reserves into physical metal. Poland added 14 tons in a single month, pushing their total holdings to 596 tons, rapidly moving toward their strategic target of 700. This is a profound geopolitical shift. Meanwhile, Hong Kong is publicly reviving gold futures trading and building out the physical infrastructure to lift their gold storage capacity above 2,000 tons in the next 3 years. They are building a literal physical fortress for wealth. They are running trial operations on a central clearing system for gold this year. These decisions are not made on a whim because some central banker likes shiny objects. The people running sovereign balance sheets are looking at the exact same United States dollar trajectory that we are. They are looking at $33 trillion in debt, and they have quietly agreed not to be the last ones left holding the paper bag. You can see the desperation bleeding into the daily exchange reports in the West. Just look at the primary commodities exchange in New York. Recently, a depository report showed a single movement of 296,987 ounces of silver. But it was not a new deposit from a working mine. It was a reclassification. A participant moved the metal from the eligible category, meaning it was just sitting in storage belonging to a private owner, into the registered category, meaning it is now actively available to settle a trade. To understand how fragile this system is, you have to understand the difference between those two words. Eligible silver is just parked metal. Registered silver is the actual inventory backing the billions of dollars in paper contracts traded every day. When registered inventories plunge, it means the ratio of paper claims to actual physical metal expands to dangerous levels. That transfer of nearly 300,000 ounces was not a sign of a healthy market. Somebody owed somebody physical silver, The metal was not there in the registered vault, and they had to convince a private holder to shuffle their deck chairs to make the delivery. The tape is not showing massive new inflows of metal from the ground. It is showing an internal shell game being played with rapidly dwindling reserves. Think of the global silver supply like a giant battery. For years, the world has been aggressively drawing power from this battery. The solar panels, the data centers, the defense contractors, the physical hoarders, we just kept draining the power. But because there was always a surplus sitting in London or New York vaults, nobody noticed the battery level dropping. Now, we are hitting the red zone. The storage buffer is running out, and when the buffer disappears, the price signal is the only mechanism left to ration the remaining supply. The price does not just go up linearly in a shortage. It goes vertical until it becomes too painfully expensive for industries to use, forcing them to stop production. That is the fundamental threshold we are walking toward right now. And then there is the final geopolitical trigger that the algorithms cannot properly price in. On May 7th, the very same day, silver blasted through the $80 barrier. Whispers emerged of a sudden de-escalation in the Middle East. A proposed memorandum of understanding between the United States and Iran involving halted nuclear enrichment in exchange for lifted sanctions. Oil prices tumbled immediately on the news, but silver did the exact opposite, surging over 6%. You have to ask yourself why a supposed safe haven asset would spike when war tensions cool. Because when energy costs drop, the fear of runaway, sticky inflation cools down with it, and when inflation cools, the central banking system finally gets the political cover it desperately needs to start cutting interest rates. If you understand financial history, you know that lower real interest rates are the ultimate rocket fuel for precious metals. It creates a perfect macro storm. You get massive investment demand seeking a store of value away from a yielding currency, while industrial activity simultaneously accelerates because borrowing money to build factories and data centers becomes cheaper. It is a dual-engine ignition, and the fuse has already been lit. Furthermore, we must look at the historical relationship between gold and silver. For most of modern history, the ratio telling you how many ounces of silver it takes to buy 1 ounce of gold has bounced between 40 and 60. Recently, it ran as high as 105. It was a massive distortion. Today, as it compresses back down towards 70, the rubber band is snapping back. If gold holds its ground and that ratio simply returns to its historical average of 50, you are looking at silver prices that will make $80 look incredibly cheap. Look, the history of money is a graveyard of paper promises. Right now, you are watching the physical world reassert its dominance over the financial one. The data is all completely public. My job is simply to point you toward it, and I always encourage you to check the sources for yourself to verify the truth. The burden of seeing these shifts early is that you have to endure the noise while the rest of the market catches up. If this changed how you see the system, subscribe and leave a comment below. The data is out there. Your job is to read it.